channel.com.au.
Welcome back. Time for our weekly segment, Absolute Return. Today the focus is investing in fixed income and credits. For more, Chris Goslin, CEO of Australian Fund Monitors, with me. Alongside him, Phil Carden, Portfolio Manager at the Supervised High Yield Fund. Warm welcome to you both. Let's, before we get into the fund, just talk generally the whole interest rate environment, the expectations driven, of course, inevitably by Fed navel-gazing, a December taper. Chris, life for fundies in this situation and daring to even bet on or against seems rather heroic, given we've been disappointed month after month, have we not?
Well, quite right. Yeah, this must be the most widely anticipated move by the Fed, but every time they try and talk it up to prepare the market drops its bundle and they sort of seem to go back into their shell a little bit. They can't do that forever. They're going to have to raise rates, or rates will rise at some time. The real question is by how much? Probably not very much, but when?
And this is the question because even before that's happened, and this is where arguably the interest comes into the fund, for instance, you've had banks moving out of cycle to raise rates. They've done that in part of their book, not necessarily a comprehensive move. So the question is, until now, it's been advantageous, as it not, to be in a fund like yours, predicated on ever lower rates. But when the worm does turn, and heaven forbid, bank deposits start to rise, deposit rates, will the fund have to perhaps recast its strategy just in light of who's wanting to be on board relative to the lower volatility of having it on term deposit, say, as an investment?
Yeah, well, we've actually moved our portfolio into all floating rate securities, right. Long-term floating rate securities, things like residential mortgage-backed securities or corporate loans that are packaged up into a trust. So as those rates go up, we'll float up with those increasing rates. We don't have any fixed rate exposure because we're actually quite bearish on fixed rates, particularly in the US.
Why is that?
Well, I think you just have to look at some of the broad economic variables that go on over there. The unemployment rate, it's been one of the biggest, longest-term recoveries in employment the US has ever seen. I mean, Clinton's era ran a little bit longer, but in terms of 10% down to 5%, that's a very big move, and it looks like there's still quite a lot of strength there. If you look at the inflation numbers, for instance, final quarter in 2014, we had a lot of very large negative numbers, which were brought on by the big commodity price moves earlier on in 2014. Well, they're all dropping out of the inflation numbers now. If you annualise this year's inflation in the United States, for instance, January to October, you come up with an annualised inflation rate of about 2.4%. Now, when you consider that the Fed's target is 2, and those large numbers are going to drop off the averaging, we could end up in March with an inflation rate, annualised inflation rate in the US, quite possibly well above 2%. And they've got to be aware of that. Everyone's got to be aware of that. And therefore, I'm very confident you'll see them move next in December.
Think of the domestic scene, the monetary policy settings here as well. The pipeline, for instance, of spend on things like infrastructure as a counterweight to any further easing by the RBA. So some idea of activity in the real economy, and therefore what issuance plenty. How are you making a determination on that?
The local economy, I think what's happening in New South Wales and also federally on infrastructure has also been augmented by what's gone on in the real estate market. I mean, you've only got to drive around Sydney to see the number of buildings that are going up, Barangaroo.
Planes on the skyline.
We've seen it coming through in the employment data. We've dropped below 6%, which I think is very positive, and I think you've got to be optimistic about jobs growth now, whilst that spend continues. We don't know what's going to happen after that, but
it sounds like you're not calling out any further easing by the RBA.
I don't think so. I think that will be more by way of interest rates in the US going up rather than us going down, because it's a relative game, isn't it, really? I mean, if their rates are at 5%, we're probably going to be at 7%, and if they're at 0, we might be at 2%.
I suppose the question would be, can a fund like this continue to outperform? Because, I mean, that's, on the numbers you are, can you continue that if everyone gets on the same side of the trade? that? Because it seems to be even on, say, going long the US dollar, it's a very crowded position now. Everyone is effectively saying the same thing, Chris. How do you get our performance to that point?
There are often crowded trades around, but the smart funds and the smart fund managers are either just ahead of that crowded trade or are smarter at doing it and can get that outperformance. The only way you can really judge that is by looking at long-term historical performance and looking at a fund's performance in a variety of conditions and have they managed to outperform? And if they've done that, and that's what all the prospectuses say as well.
Is that a problem, though? Because even the fact that the prospectuses default to saying that, it's like our expectation on trend growth and a return to that. The smart money is now saying, Phil, we may not be back to those sorts of levels ever. We're in a new normal as it goes. Even the RBA searches for a figure on trend growth, can't give us one, and probably won't know for the next 5-10 years. But it would seem that it's not going to revert. So how can performance revert to the average?
Well, there's been some changes in the structure of the banking market, bank capital, the cost of capital, and the way capital is allocated across investments. We identified earlier in the year what we saw as a transition in interest rates because of some of the things I've just spoken to, and we saw that as affecting volatility. When you combine it with bank capital changes, asset prices are just more volatile.
Has that been priced in, though, now, given the telegraphing of Basel IV even?
We don't think so.
Right.
If you look at a put-call option, for instance, on a 10-year Treasury note in the US and price that at, for argument's sake, $1.50, the market moves through that 4 or 5 times over the life of that contract. So it doesn't appear to have been priced in correctly yet. And we allocated some of our income funds into that, and that's been quite a good trade to hedge the rising rates, but also add a little bit more value to the fund. Of course, you can get that sort of thing wrong, but when you're buying options, you can only get wrong to a certain point, so you know what your downside is.
And there's another point on this. That's why you give your money to a fund manager who does all day, every day, what Phil or any other fund manager does, rather than the poor individual stuck at home who has to try and guess it.
Some of us need our 40 winks, whereas you, for your sins, probably have to sleep right or keep working right around the clock, as the case would be. Phil.
We do put the alarm on at 1 a.m. sometimes.
All right, my gosh. No rest for the wicked. Thank you so much for coming on. To you, Chris Golden, CEO of Australian Fund Monitors, and Phil Carden, their portfolio manager at the Supervised High Yield Fund for you. We've got to take a short break. Your business class, though, follows next.